Hello everybody and welcome to today's video entitled The Most Undervalued Growth Stocks in My Coverage Universe. And if you're used to these Friday videos, which they should be on Fridays from now on for a foreseeable future because I am back for good in the US. If you're used to these videos, just feel free to take a screenshot and look at the updated valuations for each of these stocks, knowing that I did a full update. I went through everything from the next 4-quarter growth to forward gross margin to gross profit to revenue. I did a full update of the spreadsheet. Those numbers, you will not find any mistakes as of today. And I have also removed a few, just 3 of them, but I've removed 3 stocks that really I don't cover much on the channel anymore. So it doesn't make sense for me to talk about stocks that I don't really cover on the channel. And so I've removed a few. And if you're used to this spreadsheet, you'll see a few stocks are gone now. So now that I've put that out of the way, if you are new to the channel, welcome, and let me tell you what I do on this channel. So what do I do on this channel? I focus on growth stocks, namely hyper growth stocks. And how do I define an hyper growth stock? Well, to me, that is a stock that's going to have revenue growth over the next 12 months that is over 30%. So I want the companies that I invest in to take in 30% more dollars each year after year. And why do I do that? Well, I do that because I estimate that a good return for me would be a doubling in 5 years. That's I don't want any more, any less. I'm in my 30s. I don't want crazy risk. A doubling in 5 years is what I'm looking for. But to get a doubling in 5 years, you need to remove monetary inflation. And I estimate monetary inflation to be at 15%, which is why I require a 30% revenue growth increase. And this is all based on the theory. If your price to sell on a stock doesn't change and the sales increase, right, by 30% each year, the return that you're going to get on that stock is going to be 30% as well. So that's assuming no changes in price to sales valuation. And I use a few metrics on the channel in general, but the more relevant metric that I use on this channel is the enterprise value over gross profit metric. It's my favorite metric. And why is it my favorite metric? Because I use enterprise value because I want to penalize companies that have a lot of debt, right? Debt adds itself onto enterprise value, right? That's why if you look at a company like a GM, for example, it looks like it's only a $50 billion company. No. It's closer to a $200 billion company because they have so much debt. So my spreadsheet, for example, would help a company like Tesla that has no debt and helps companies that have no debt. So that's why I use enterprise value and not market cap, contrary to a lot of people, right? A lot of people just use price, market cap. No, I use enterprise value. And then I use gross profit. Why do I use gross profit? Because all of the stocks that I invest in are typically optimized for gross profit. And my style of investing is the product adoption style of investing. I like to invest in stocks before they start to show earnings that make sense, because by the time a stock starts showing earnings that make a little sense, I want to be out of that stock. That stock is not growing anymore for me. I want to invest when a product, when a service gets adopted and is getting adopted. And this is essentially, in a nutshell, the essence of my style of investing. So I try to look at companies. Take the example of Tesla. I just use Tesla as the first in my spreadsheet here. I would get into Tesla now. Tesla is my biggest position, and I invest into Tesla. Why? Because right now, electric cars are about 6% adopted, and Teslas are about 4% of all of the electric cars sold, at least if I use US data. So we're between 4 and 6% right now. We're early. We're in the early adopters game. A stock like Tesla, by 2030, when everybody has an electric car, right? When we're at like 70-80% adoption, that's when I want to get out, because the growth will stall once most of the population has adopted the product. And when most population has adopted a product, then these companies become industrial giants and they become more steady Eddie stocks, and they can start paying a dividend and they can start trading on valuation. Not what I'm interested in. I'm interested in companies that are seeing huge adoption of their product, and I want to ride it all the way up And once the products stop getting adopted because everybody has bought in, everybody's bought them, right? Once it just remains a replacement market, I don't want to be in the replacement market, and I move on to next stocks. And that's what I hope to do for a few more decades before retirement. And in this spreadsheet, I always begin by telling you which one is most highly overvalued and most undervalued. So let me get started. The cheapest growth stocks in my universe, the least valued stocks are out in all of the stocks that I cover are HIMS, StoneCo, and Lovesac. Love is technically second and StoneCo free, but they're dirt cheap. So you're paying a 0.04, 0.07, and 0.06 price for each percentage point of growth, while the average ratio that one pays, if you take all of the average of my spreadsheets, is a 0.53 for each percentage point of growth. So what is this ratio? That's enterprise value over gross profit over revenue growth, and it's my spin on the PEG ratio of Peter Lynch, except I've modified it to use enterprise value because I prefer enterprise value over market cap, and I've modified it to use gross profit instead of earnings because these are companies that grow really, really fast and that are very early on, and I have used, of course, revenue growth, and it asks the question when you divide by revenue growth is how much are you paying for each percentage point of growth? How expensive is that forward growth? And in the case of HIMS, in the case of StoneCo and Lovesac, the forward growth is absolutely not priced in. And what are expensive stocks? Well, they are two stocks that I sold actually based on this spreadsheet. It's a Shopify and Nvidia, right? Nvidia is outrageously expensive at 2.59. So the growth at Nvidia, you're paying up for each percentage point of future growth. You're paying up 5 times as much than the average stock in my spreadsheet, right? And you're paying up 500 times as much for that future growth in Nvidia as one would be paying up for future growth in, say, HIMS. So that's a very, very, very expensive stock. Nvidia literally cannot be allowed to go wrong at all to justify this valuation, which is why I sold it. It may have been a mistake. Selling a winner may be a mistake, and it's half the journey to realize that it may have been a mistake for me to sell it, but I made a video on the channel covered why I sold it. I also sold Shopify. Shopify I find expensive for e-commerce because e-commerce is a low margin business. Retailing is a low margin business, and so when you're commanding these valuations, and you can also buy like a high quality company like a MercadoLibre, it's tough for me to justify this high of a valuation. I also think the valuation of Shopify has to do with the fact that it's a Canadian company, and Canadian companies tend to be very expensive in the market for some reason. Whenever I look up at a Canadian company in the market, I find them very expensive. So anyways, so let me now begin. And the way I do this, of course, is I go through megatrends, right? Since I'm talking about product adoption typically happens within different megatrends, and all of these megatrends are early on, so I'm just going to go through each stock in the megatrend and tell you a little bit about them and why I like them. But these are all of the megatrends that I invest in and that I like. And so let's go. So what is the first megatrend? Well, the first megatrend, and it's also, in my view, the most important megatrend, it is the energy revolution. Energy underlies everything that we do. The economy as we know it today, the service economy that we have today, and prior to that, the industrial age economy that we've had today, it was all made possible because of energy, right? Energy is directly linked to productivity, and energy is so essential to everything we do. And I've identified 3 stocks in the energy space that are going to help with this energy revolution and this energy demand that we're going through. So the first one is Tesla. Tesla is a little expensive, but you see, in the way I value stocks, Tesla is like it's not a nosebleed valuation if that makes any sense. Like you look at your average SaaS stock like a Palantir or a MongoDB, the way I value stocks, I see those as more expensive than a Tesla, right? If I go down, I have a lot of companies like AMD, Nvidia that end up being more expensive than a Tesla. So Tesla is expensive. You talk to any traditional finance folks, and 90%, they'll tell you it's nosebleed. But when you judge Tesla through the lens of growth investing, it's actually not that expensive. It's a little pricier than average, but you could argue make a strong argument that it's a little bit of a better quality company than the average company too, and so I don't have a problem owning that company for the long run. Tesla is my biggest position. The reason for that is because you let a winner run, and that's why maybe I should have sold to Nvidia, but Tesla is one that I've let run. It's the biggest position. The company is still growing at 50%. It's my estimate, and this is based on the long-term goal of Tesla to say that they're going to grow deliveries of vehicles at 50% for the next decade. Now that prescription is about 2 years old, but at least until 2030, I think it's reasonable to expect a 50% increase in vehicles delivered. That should translate roughly to 50% revenue growth. And of course, when you're growing at this tremendous scale, it makes for a very, very special business. Electricity is getting adopted. Electric vehicles are getting adopted. Why are they getting adopted? Because they're a better technology than internal combustion engine vehicles. The best argument that I have for electric vehicles is that driving 350, 400 miles is going to cost you $7 to $10. Doing the same thing with a SUV the size of a Model Y in the real world is going to cost you $70 to $100. So this means that effectively driving an electric car is 10 times cheaper. And I'm not even including all of the things that are 10x better with an electric vehicle. You know, if you like sports driving, if you like cars that accelerate fast, nothing ever beats an electric vehicles. They literally can't be beat dollar for dollar. It's not possible. If you don't like going to the gas station, nothing beats charging at home, and so on and so on. Tesla is also a little bit of a Standard Oil of electricity in the sense that they have their charger network, they have their energy division. It's too big of a company to do it justice in just a few minutes. So I will move on to the next stock in my universe, which is Enphase. Enphase is a similar story to Tesla, but Tesla, you're looking at electric cars and how they are getting adopted. Enphase, you're looking at roofs, solar roofs. You drive around your neighborhood. How many roofs do you see with solar right now? Probably 5 to 10%. Depending on whether you're in Europe or whether you're in the United States. In the United States, a little closer to 5% of the roofs have solar. So there's a tremendous avenue for growth, because when you start studying solar from a fundamental standpoint, you realize it is the absolute cheapest energy that you can get. And my bet here is that most residential homes, most residential roofs will have solar, because solar today, realistically, that's between a 5 and a 9 year payback on a solar system, and you are eliminating your electric bill, literally eliminating, right? Or reducing it by 95%. That's what happens when you get a properly sized solar system today. And of course, that means that it's the cheapest energy, because electric bills are going to rise. They're going to keep rising. Those costs are going to keep going up, and more people are going to realize, well, wait a minute, let me place 30,000 worth of install on my roof and let me eliminate a $4,000 electric bill. And it's going to make way more sense as both the electric prices rise and as the costs of solar panels decrease, because they are decreasing exponentially, these costs for solar panels. If you look at the cost curves of solar panels, it's dirt cheap. In some countries, solar panels are cheaper than plywood. And so to me, it's inevitable. It's like gravity. Most single-family homes will have solar panels and produce their own energy, just like we all have fridges in our home, and we don't go to the ice box downtown in the village to get some ice for the week. No, we make our ice at home. The same is true for electricity. Why do we connect to the utility? Well, we can just make it at home with our roof space and the fusion in the sky, the little reactor called the sun that we have in the sky that sends us more than enough energy for most of our needs. STEM. What is STEM? STEM is a smaller player. As you know, I look for hyper growth stocks, and so sometimes when you look for a hyper growth stock, you have to go with a little cheaper. Well, it is a cheaper company, but smaller company. STEM is of course way more than an order of magnitude smaller than Tesla. What is STEM? They're an installer of mega packs. They install these behind the meter and front of the meter battery pack system for corporations and for the grid and for the utilities, actually STEM is the number one of the top installers of Tesla megapacks. Actually, STEM and Tesla, they have an interesting relationship because STEM is an installer of megapacks, and STEM still supplies mostly megapacks, right? More than 50% of what they install is megapacks, and they also install what I'm going to call Chinese knockoffs that they get from China. So this is a company that's in the installation of front of the meter and behind the meter battery systems, because companies want to get off grid too, and companies want to generate their own electricity and store it themselves too. The battery for businesses is also extremely essential because, in my view, we're moving to an electric truck future. And keep in mind the incentives of an electric truck, right? Saving 10x on your gas bill as a household is appealing. Saving 10x on a gas bill as a company is an imperative, which is why electric trucks are also going to get adopted, because it is a much, 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 much cheaper technology. But in order for an electric truck to get adopted, you need to be able to charge it within a minute, right? And how do you charge an electric truck in a minute? You need what they call a megawatt charger. Now, if you follow Tesla, they went for a 900 kilowatt charger, but that's okay. That's roughly the same, right? 900,000 watt, 1 million watt, that's about the same. That's how you can charge a truck. You need a charger that's going to deliver 1 million watts. And how do you deliver 1 million watts? Well, the grid can't handle that. The only way to do that is to have a battery system that kind of reloads in between charges. And that's what megapacks are for, and that's what STEM installs. And of course, STEM, the company, is seeing huge growth at 87% over the next 12 months. And the reason why would one, in my view, why one would want to invest in STEM is because they don't want to be in the hardware install business. You don't want to be in the engineering of systems business. You want to be in the software business, and STEM has 100% attach rate of its software to the hardware that it installs. So the hope is that over the long run, this turns into a software story and less of a hardware story. But in the meantime, as this company ramps, they have to install the hardware for which software is going to be sold. And that's in a nutshell the story of STEM. So this were the energy revolution stocks. Let me move on to healthcare. So you may notice I had TelaDoc in the past. I have removed TelaDoc. I have been disappointed in TelaDoc. And the vision of healthcare, I now see it fully with HIMSS. Actually, a few while back, I sold my TelaDoc and put it in HIMSS, and I think that was a very, very good decision when you study the business itself. I don't look at stock price, but I look at the business. HIMSS is a company that is a healthcare company as opposed to a sick care company, which is what most of what we call healthcare today is actually what I would call sick care, and I would call a company like HIMSS healthcare. The fundamental distinction is that what we consider healthcare today is really something that you deal with when you are ill. When you are in trouble is when you go see the healthcare system. HIMSS treats minor stuff, minor issues before they get bad. And as a result of that, they focus on buying health as easily as clicking on the Buy It Now button, right? It's the Amazon culture. It's the customer-centric culture. The big difference between HIMSS and, say, using your own insurance and going to see a doctor is, imagine in most big cities how long it takes for you to see a specialist to get a prescription for a minor issue, right? You have to get to a primary care physician. That probably takes a few months. And then you need a referral. And then you need to wait another few months to see a specialist. And then you get a prescription, typically a written prescription, a piece of paper. And then you have to drop it at a physical pharmacy. And then you have to wait in line at the physical pharmacy. And you have to go get your refills. You have to drive to the pharmacy, go get your refills, drive home. Hopefully they have it. If they don't have it, they have to have a phone call to another pharmacy, tell you, hey, do you have the drug? Yeah, then they send you to another pharmacy across town. If you're familiar with the healthcare system, you're probably all too familiar with what I'm describing. In the era of 2-hour shipping, why do we have a company like CVS with 9,000 pharmacies? We don't need that in 2-hour shipping time, overnight shipping. You don't need this anymore, right? It's just like the branch store. You don't need branches anymore if cash is disappearing. So HIMSS is a disruptor of the legacy pharmacy business and the legacy doctor business. And that's a dual disruptor. And also the doctors, right? That's the same story. Why do you need to see a physical doctor physically, right, in their office, while we know that 70 to 80% of a doctor's visit can be done digitally, fully remotely. It's actually a tiny portion of doctor's visit where you have to be physically present with the doctor. So HIMSS is solving that, of course, with technology. You have an app, you meet with a doctor. The doctor could be on the other side in the US, in a less busy part of the US. You do your consultation, and if you're a go for a prescription, you get a prescription, you get it in the mail the next day. If you're not a go for a prescription, you get some education through the app, you remain friends with the app, and you can keep doing your business with the app until you get a prescription. And of course, HIMSS is able to do that because they're outside of the healthcare system, they're outside of a legacy healthcare system, they're outside of an insurance system. You don't have to go through insurance. HIMSS is entirely outside of insurance. And as insurance try to nickel and dime their customers through copays, right? That's kind of a big business model for the legacy insurance business, is putting a high copay so that you will dissuade your clients to really use the product because you have a copay, and people are like, oh, okay, I'm not going to get that drug because I have to pay a copay. HIMSS undercuts copays. Right, the cost of HIMSS is oftentimes, for many of their drugs, cheaper than copays because they're still generic. It's a complex company. Few, I believe, understand it or treat it fairly, but that's the case of all of the stocks that I cover on this channel. All of the stocks I cover on the channel, few people really agree with them because they're early on. Remember, I could show you this again. They're early on in the adoption, and so if you look at electric cars, I told you 6%. 6% of people who have them. So of course you're going to be going against the grain, right? I may not be going against the grain here because this video was likely recommended to you, so you likely agree with me on a few things, but you know what I mean. Okay, let me move on to data warehouses and data monitoring stocks. So data, that big data is a field we've been talking about for the past 10 years, and today we're kind of in the harvest phase of this big data promise. I have 4 stocks in what I loosely call my big data category, although it's technically data warehousing, data lakes, data monitoring. So I have Datadog, Snowflake, Palantir, and MongoDB. So these stocks actually took a little bit of a breather. They got a little bit cheaper. Datadog, big miss the other day, got cheaper. Right, Snowflake got a little bit cheaper, although it's still quite expensive. Palantir got also a little bit cheaper, even though it's quite expensive. And MongoDB is still an expensive company per my spreadsheet. But what these companies do make a lot of sense, and what they do is companies are moving from a human-driven phase, right? All corporations in the world have been human-driven until the 2010s. We're moving from a human-driven world to a data-driven world or a computer science-driven world, and that's what these companies do. These companies enable other companies to operate fully, a little bit like a machine, right? Like when you operate a machine, the machine just works. Well, companies are kind of like that. Their data being connected by other data systems, and those data systems help you make decisions for the business. And that's what all these companies do. So Datadog, what does Datadog do? Datadog is a data log company. In a way. So what it does is it scans all of the connections within all of a company's IT, all of these connections, all of these systems, legacy system, tech debt, modern system, they're all connected together. And sometimes there's a glitch. And whenever there's a glitch, you can go on Datadog and you can look at where the issue came from within the machine that the modern corporation is, right? And so you can easily see and track bottlenecks and problems within your company thanks to Datadog and within all of your different apps, which companies today, they're more and more resembling a bunch of different IT apps stacked on top of each other. Datadog does that. Now, what about Snowflake? Snowflake organizes your data in a cloud, which is their data cloud. They call it the data cloud. Snowflake aims to have most companies upload their data in the cloud and not keeping it on premise on old Linux servers, etc. And it's a complex business that includes many aspects, but one of them is processing the data on the cloud, analyzing the data on the cloud. That's one aspect. Another aspect is governance of the data, right? If your data is in the cloud, it's easier to make sure who is allowed to see that data and who is not allowed to see that data, and give permissions for the data. That's very important aspect of Snowflake. You can also build applications on Snowflake and have your different IT systems connect to Snowflake and use APIs and things like that. And another thing that you do with Snowflake is data sharing. So you can be two companies that get together. If they both have their data on Snowflake, they can just share whatever data they want with each other. So the way to think about Snowflake is a data system or an operating system for the data of your corporation. And it's really, it's this whole business analysis phase that we're in, right? Snowflake is trying to have data apps, which would be an app that makes a decision for you on your data, but it's still early on for Snowflake. If you want to talk about data apps, then it's the era of Palantir, right? Palantir is the way I would describe Palantir is they're pushing an operating system for corporations. That's the way I look at Palantir. It's an operating system for corporations where you can actually make decisions on the platform, right? On the layer of data that is analyzed by Palantir. You can then make decisions directly on that platform. And of course, the most successful iteration of that or product of that is the Gotham software that they have for the military. If you're curious about how many military operations are operated, Palantir plays a central role as the main operating system of these operations. And this is a company that has started with the military. And I actually own Palantir mostly because they have a shot at becoming a fourth contractor of the U.S. military, in my view. And the U.S. military is what, was it seven? I think it's between $700 and $800 billion of spending each year. That's kind of the size of the market, right? And so with inflation up that a little bit, add 3 or 4 years, it will be $1 trillion market up for grabs, and that market is the U.S. military spending. And Palantir just doesn't need to grab a big share of that to do well. You know, the revenue is only $2 billion, right? If all of the militaries of the world spend, I don't know, $5 trillion altogether, and the allies of the U.S. get to buy the software, that's a tremendous market. That's enough for me to buy the company. But of course, most people who follow Palantir love Palantir because of their commercial software, and they're trying to do the same thing for commercial, and sell this operating system for companies. They've had quite a bit of success with your legacy industrial/engineering firms. They still have to make strides with more modern firms that are more service-oriented, in my view. MongoDB is a niche database player that is a NoSQL database. And so the best way to look at it, at least that's the way I define it in my mind, is Snowflake is for SQL data and MongoDB is for non-SQL data. And you have a lot of developers who like the Atlas service of MongoDB, and this is a company that has stellar numbers, stellar growth. And really, I mean, the essential question to ask yourself is, do you believe in data? Do you believe that we're going to live in a data-driven world and not in a human-driven world in the future? Is it just data that's going to make the decisions, right? Take a self-driving car, right? A self-driving car is just the data making the decisions on its own, independently. All of these companies go in that trend, and that's why they are highly valued, because I think it is consensus that we're moving into a data-driven world and less to a human-driven world. Decisions are made more and more based on data. Predictions are made more and more based on data. And these stocks, to me, do a great job capturing this opportunity, in my view. Moving on to cybersecurity. So cybersecurity is the same story. It's getting adopted it's been up and coming for 20 years, but this time we're seeing some serious strides and some serious adoption in cybersecurity. As we live in cyberspace, which we all do nowadays, the definition, in my view, of living in cyberspace is how many hours do you spend in front of a screen? If you spend more than 8 hours a day in front of a screen, you live in cyberspace, right? The security guard at the mall does not really matter much anymore. Now what matters is the security guard in the digital mall. And the digital mall is, I don't know, your shopping site. That's an example. Your office security matters less today. What matters is the security on your device, on your laptop that you bring home and you walk from home. Does it have the right security, right? You don't need that front desk security guard anymore, but you need a security guard on your devices, on your edge devices. The same is true for just about everything. Imagine a self-driving car. Imagine a Tesla. You better have tremendous cyber security on your self-driving car, otherwise someone can take control of it and do something with it. So anyways, very important. I have identified 3 companies in this space that I very, very much enjoy. One of them is CrowdStrike. The other one is Zscaler. The last one is Cloudflare. CrowdStrike, what is CrowdStrike? CrowdStrike is cloud cybersecurity. They have the biggest network of computers connected to each other. Whenever there is a breach somewhere to one of the computers, that breach is broadcasted to all of the computers on the network, which get updated, which means that if you have hundreds of millions of devices, there's a breach somewhere, that breach goes to the cloud, is broadcasted to everybody as the software, and the software updates in real time. And that's why I believe this is a winner-take-most market. This is why I believe CrowdStrike, I think, has a better positioning in this space than, say, a SentinelOne, which is kind of a number 2. And you don't want to be number 2 in a winner-take-most market. You want to be number 2 in a normally distributed market. That's fine. But being number 2 in a long-tail distribution is not fine, because then, the winner takes most, right? It's kind of like winning the lottery. You don't want to be number 2 at winning the lottery because you're not going to win anything. You need to be number 1. Moving on to Zscaler. So Zscaler is, in a nutshell, is for when CrowdStrike fails. When CrowdStrike fails and one laptop gets infected, what matters to you next is that fire that was spread on that laptop does not spread to the entire network. And that's what CrowdStrike does. It's zero trust. They pioneered zero trust, and the idea of zero trust is that you don't have any connection between any devices on the network that does not go through cybersecurity. So Zscaler prevents the spread of the fire from one laptop to another laptop, or from one laptop to the server, and from the server to the whole company. That's what Zscaler does. It's the castle and moat system, and it's a very interesting company, in my view, the cheapest one in the cybersecurity space right here. The last one is Cloudflare. So Cloudflare is the more expensive company in that field. I'm not adding to Cloudflare right now. I find it a little pricey. What does Cloudflare do? What do they do? Well, what they do is they're kind of a VPN for websites. They hide the IP address of websites so that you can't have a DDoS attack made against your website. So if you hide your address, once you're a company and you broadcast a website, if you hide your address, nobody can really attack it. And that's some very, very powerful stuff in my view. All right, so let me move on now to my e-commerce companies. So e-commerce, of course, has been around for a while. That's perhaps one of the earlier trends out there. So if I go back to here and I show you here 5% adoption, e-commerce, we would be closer to, say, a 30 to 40% adoption, depending to where you live. So we're reaching the end of that megatrend. Nonetheless, there are some fascinating companies in e-commerce. There's 3 of them that I like, that I've identified. MercadoLibre, C Limited, and Shopify. So really quickly, C Limited and Shopify are companies that I'm not adding to. Shopify I'm not adding to because I find it very expensive. What is Shopify? Of course, Shopify creates a lot of websites for independent companies that try to sell online, and they have a lot of actually publicly traded clients, and really a lot of SMBs sell on Shopify. And when you log in on a Shopify website, you wouldn't know it's Shopify. Most people don't know they're dealing with Shopify. So as an example, if you're buying, whether it's the Tesla accessory store or whether it's the Figs website to buy scrubs, or whether it is, there's another one in here that uses Shopify. I can't remember which one. But if you log into any of his websites, they use Shopify. So publicly traded companies pick Shopify to operate their sales website, which is some very powerful stuff. But it's a very expensive company because Shopify is obviously the leader in those digital stores. The leading operating system of an online store is Shopify. And yeah, very expensive, very expensive. I don't have Amazon in there, by the way, because the growth is too small as well. And Shopify, I could ding them a little bit for that 20-ish% growth, which I find too small for my taste. The second one is C Limited. When it comes to C Limited, I love Shopee. Shopee is a great business. They also have a e-finance, right? A fintech business with C-Money. C Limited is doing very well in Indonesia, doing very well in Southeast Asia. The problem with C Limited is that their game got banned in India, and so they're showing big declines on their third division, which is their gaming division. And so in the revenue growth number, it doesn't look as stellar because they have a division that's steadily declining, which is their video gaming division. And then MercadoLibre. MercadoLibre is my favorite out of the three. MercadoLibre is a leading company in Brazil, in Argentina, in Mexico, and in several other smaller Latin American countries. MercadoLibre is their main digital shopping website that they use. It's a platform with buyers and sellers meet, and they're kind of like, I mean, it's funny to say it like that, but they're kind of like an Amazon without AWS. But it's instead of AWS, they have a fintech division as well. So Mercado Libre, they have Mercado Envios, where they do their shipping. They have the website, which is very, very popular in a lot of Latin America, and a lot of people really love it very much. And this is a company with stellar execution. They've had very good execution. And they keep showing strong growth. I've covered Mercado Libre a few weeks ago on the channel. Their earnings were really good, and to me, Mercado Libre is really a sleep well at night kind of stock. I mean, it's steady Eddie. The growth is great. They are leading in their market. We have a leading e-commerce website. It's not Amazon over there. It is Mercado Libre. And they're still earlier on in that growth, such that you have more growth ahead than, say, an Amazon, who's already the leader in the US and the leader in Europe. Leader today, they're going to remain the leader, but the growth is going to be smaller. Moving on to my payments company. So payments company, why do we care about payments? Well, it's the same story. It's the end of cash, and even further after the end of cash, the end of the credit card. So I just want to go ahead and tell you quickly about DLocal and Square. DLocal and Square, I like these companies very much. I am staying out of it because they both have some overhang with a short seller. I think Square was more hurt by their short seller than DLocal, although both of them got under attack. But the reason why I stay away from them also, at least in the case of Square, is that the growth has stalled at Square at 11%. It's not as good of a growth, and these companies are a little more expensive. To me, the best payment stock right now is STNE StoneCo. StoneCo is really the best. What does StoneCo do, in my view? It's the Square of Brazil. By the Square of Brazil is they have these payment terminals in all of these businesses in Brazil, and more, by the way, StoneCo is moving to their app, and they're disrupting the world of payments between customers and companies using their banks to process these payments, moving away from using the bank to process the payment to actually using those little payment terminals from StoneCo. And again, I think another very important point that I'm philosophizing about or thinking about heavily right now is what's going to happen with apps like Pix in Brazil, or FedNow in the US that they're launching. Right? It's really the next stage of the credit card. There's evolution in the way we pay, and the credit card is losing prominence. I hope there's no Visa fans in the audience, but it is losing prominence. More and more people are using their phones to pay. They're using apps to pay, and that's part of that megatrend in my view. The way we pay for things is changing. Now, the payment space, you also have to be a little careful in the payment space, right? It's a take rate business. It's a business where you earn a small percentage of how many people spend. Therefore, these businesses tend to be very correlated with the velocity of the money, how many times the money changes hands within a country. And last year, when we had fears of recession, these stocks really got hurt because a lot of people would think, well, we're not going to transact as much. We're not going to pay as much. Instead of making X amount of transactions a year, we're going to make fewer transactions. And these are stocks that are very much dependent on how many transactions are made and how much money changes hands. And this is where a country like Brazil becomes very interesting for StoneCo, where the velocity of money is much higher for Brazil because it's a more youthful population. Young people trade money from hand to hand much more often than older people. They have higher velocity of money. Brazil also has a lot of small businesses, and of course, I would be mistaken if I was not telling you I love StoneCo. Why? Because that valuation is ridiculously low. It is much cheaper than its peers, and I do not understand why, aside that it's a forgotten stock, but it's a stock that's owned both by Warren Buffett and Cathie Wood still today. They both like the stock. It's a stock where growth investors and value investors can agree on, and there's not that many of those. Moving on to a category where growth investors and value investors absolutely do not agree on, it's the chip makers. So I have 3 of them. So like everything, I have a it's funny because AMD is kind of a mega cap. I was going to say I have 1 mega cap, one medium size, and 1 small cap, but actually no, I have 2 mega caps and one small cap. So of course the chip makers, right? So we talked about data, we talked about AI a little bit. Over a layer of data, right? You have the data, and then you have a layer on top of a layer of data. You run an AI. How do you run those AIs? Well, you need chips, right? You need your little silicon. You need your trillions of transistors engraved on silicon, which is what these companies do. Keeping in mind that all 3 of these companies don't have fabs, right? They're not in the making business. That's TSMC. TSMC makes the stuff. Intel is trying to get back into making the stuff. No, these companies are engineering giants. They are intellectual property giants. At least in the case of AMD and Nvidia. Nvidia is the leader in GPUs. GPUs, you need 8 GPUs for 2 CPUs. GPUs is where the money is at right now in the chip space, and that's why Nvidia is doing so well. It's a $1 trillion company. The growth is really good from this base at 28% forecasted growth. That's absolutely tremendous. Although they've had a slump in sales over the past 6 months due to the overhang of laptops. A lot of laptops had been sold in 2020, 2021, and so they've suffered from that overhang. But the growth has resumed. And these are companies that are fairly profitable for hardware. Extremely profitable for hardware, more than 50%. And their products are essential for the AI revolution. So there's a little bit of hype right now, which is why, in my view, it's very expensive. Even though it's obvious to me that these companies are right at the heart of their megatrend, and they're growing very fast. I like AMD better than either Nvidia or Indie in those. I like AMD the best because AMD is kind of a diversified company. They have 4 major divisions, including an embedded electronics division. They have a successful CPU franchise with their EPIC. They call them the EPIC CPUs, and they have some popularity in their niche field and niche space, but the growth is a little lower, but the valuation is way lower than, say, an Nvidia. So I like AMD the best. Indie Semiconductors, I think Indie is a riskier stock, although the growth is stellar. What Indie does, it's an original equipment manufacturer, i.e. an OEM, for a lot of the Tesla competitors in the electric space and the electric field. Indie, I've covered a few times on the channel. It is more of a speculative company for sure. Moving on to the lifestyle stocks. So I have 3 lifestyle stocks. I have Celcius Holdings, I have Lovesac, and I have Figs. Celcius Holdings is a stellar company. I mean, there's no other way to say it. Are they pulling off another monster beverage? That's the question to ask yourself. Seldom do you find yourself in a convenience store or in a grocery store in the US where you don't have a giant Celcius booth, you don't have a giant aisle filled with Celcius products. These products are absolutely everywhere in the US. And, what makes me bullish about Celcius is that they're nowhere in Europe. I was in Europe last month. Nowhere to be found in Europe, but they're all over in the US. It is the popular beverage of today, the popular beverage of the day, and they seem to be overtaking Monster, and of course Red Bull is even more niche, which was already kind of overtaken by Monster. It's a field that a lot of people want to stay away from. The beverage field suffers from a reputation of the 1970s, where and it's still the name of the game. The name of the game was, it's all about distribution. And thus you have a duopoly, you have Pepsi, and you have Coca-Cola. They have all of the distribution. It's a tough business. You can't ever get into that business. Except I think a lot of people get stopped thinking about the beverage business because they think you can't get in the business. But Celcius has a partnership with Pepsi for distribution. So they have a partnership so they can get distribution for their product. Hence, it's just a matter of the quality of the product. And I would say in the case of Celcius, the quality of the product is pretty good. I mean, I've had it. It really, really wakes you up. This also, and this is why it's called a lifestyle, like a lifestyle trend. This goes within a grand trend over the past 40 years of finding coffee substitutes or coffee alternatives, right? So Celcius is selling a coffee alternative in a way. It is a product that has caffeine, and thus it's addictive, and therefore people keep going back to it because caffeine is addictive and it has a lot of caffeine. And that's the same concept as, say, for soda, right? Soda is kind of the same concept. Polarizing industry. A lot of people don't want to get into it, but keeping in the spirit of finding stocks that are going to get adoption, that are going to see adoption, the question that one has to ask themselves is, will Celcius 10 years from now be a top 5 beverage? Will it be the size of a Monster? If it is the size of a Monster beverage, I believe the stock has a multi-bagger potential, even from this level. Okay, I've talked too much about Celcius. Let me move to Lovesac. What does Lovesac do? They do kind of a similar thing to the old versus the new, right? It's an old story. I define Lovesac as a disruptor in the furniture space. Right, so they're trying to replace, say, recliners. Recliners are very popular in the US, and they're coming up with a product that looks nothing like a recliner, which is called a beanbag. And these used to be very popular in the 90s, in the 2000s, and they're trying to do the same thing with a disruption of sectionals, which they call Sactionals. I would be lying if I was saying that this stock is in there because I love furniture. No, I don't love furniture. I don't have any opinion on furniture. But I do love valuation when I see it. And when I see valuation like Lovesac, it's absolutely insane to me. I don't understand. I mean, this is a company that's trading at an enterprise value over gross profit of 1. This company is trading for 1-time gross profit. So gross profit alone is twice as cheap as HIMSS. This company is dirt cheap. It has a little bit of lower growth than, say, a HIMSS, for example, which is why it gets penalized in my enterprise value over gross profit over revenue growth. Of course, it gets penalized. But wow. I mean, it's still extremely cheap. I think the market has lost its mind on Lovesac. I really do. I mean, it is linked to the real estate. They're like, oh, people are never buying real estate again. Thus, wow, people are never ever going to buy furniture again. Let's sell that stock because furniture is obviously never ever going to get bought again. And it's obviously not true, in my view. So that's a lifestyle stock, right? And then the last lifestyle stock, similar story, you have Figs. Figs, what does Figs do? Figs is trying to pull off what Lululemon pulled off with yoga pants. Yoga pants used to be this very obscure clothing in the 90s. Nobody wore them outside of a yoga studio. And today, I mean, go to any grocery store, go wherever. People wear yoga pants daily. They took a piece of clothing that was not popular, made it popular. Figs is trying to do the same thing with scrubs. Scrubs are still mostly worn at hospitals. What they're trying to do is make scrubs fashionable and get them out of the hospital and out in the open for everyone to wear. So it is a lifestyle brand in the sense that it's trying to be a new brand. It's trying to create something new. And it's not the first time in the history of clothing that outerwear becomes mainstream. If you go back to the history of jeans didn't used to be a thing, and then they became a thing. And when jeans became a thing, Levi was richer than any gold miner out there. And so that's the whole story here, is they're trying to pull off a Lululemon. And if you look at the performance of Lululemon over the past 15 years, absolutely outstanding performance. So that's the reason why I love figs. And this category in general, the lifestyle category, which I call, is a category that we owe to the change in culture and to the change in advertising, right? Gone are the days where only the very large company can promote its products because it's the only one who can advertise on the evening news, right? Before the evening news, if back 50 years ago, you were that one company, you could advertise on the evening news, and boom, you had a brand, and that's how all of the brands got created. Coca-Cola, Tide, you name it, right? Today, there's more opportunities for niche, and these companies are trying to create brands for the generation that is replacing the old generation. Hence, it's likely following this adoption curve, right? Think about yoga pants or think about scrubs. If it's a thing, we don't see anybody wear scrubs right now. What if 15 years from now we see everybody wear fashionable scrubs? You will have gone through an adoption curve, and it's not the first time we have those. Let me move on to my cloud niche business. I added this one recently. I have two of them. I have DigitalOcean and Axon. Cloud computing is it's a 10-year-old adoption story, but the whole idea is that companies don't want to keep anything on premise anymore. They just want to outsource that to tech companies that are much better at managing cloud and running everything into the cloud than, say, your company's IT workers. And so that's why a lot of companies are moving to the cloud. I focus on niche, of course, because buying into the main players, whether it's Google and GCP, Amazon and AWS, or Microsoft and Azure, those big players, you have to buy into the entire conglomerate, and you're just not going to see that growth that you see in the cloud space if you buy into a niche. And DigitalOcean is the tinier company of the two. They have a niche for small businesses and developers, and they offer tiny cloud solutions for small businesses. And it starts at like $50 a month. And for $50 a month, you can set up a cloud like a very big company, except it's you're a very small company. It's a niche business. Axon, you may be surprised why I put Axon in the cloud business, but the reason why I put Axon in the cloud business is because obviously, right now it's their growth business. It's where they grow, right? And Axon started with defense products, and then it continued on with digital cameras, and now that it has installed digital cameras on police officers, that's the main business. And now it's digital cameras on police officers. They're moving on to uploading those digital videos to the cloud. So there are cloud for police stations. And that's, to me, a very exciting story because it's of course, you're dealing with intangibles. And when you deal with intangibles, you have higher margins, higher growth potential. You're not stopped by bricks and mortar. You're not stopped by atoms. Bits scale faster than atoms, essentially, in a nutshell. So I like these two companies, although I realize they are a little bit more niche. Moving on to my neobanks. So what is the general thesis of neobanks? Obviously, we don't need branches anymore. Cash is going away, whether we want it or not. Governments, of course, are going against the grain and do not like cash at all. But youngsters don't like cash at all, right? If you look at the youth, if you understand the mind of, say, your average 10 or 12-year-old. They'd rather have Robux, for their birthday than a $20 bill with a little Thomas Jefferson on it. Or is it? No, it's Jackson, Andrew Jackson, with a little Andrew Jackson on it. Andrew Jackson doesn't mean much to the younger generations, and so we are trading icons of dead men, as the saying goes. Is this still gonna be a thing in the future? No, I don't think so. I don't think it's gonna be a thing in the future. So it's the end of cash, and so therefore we're moving to a fully digital world, and thus the legacy banks, they're kind of in trouble because, if you take Bank of America, I think Bank of America has more than 7,000 branches. You have inertia as Bank of America if you have 7,000 branches. You can't do the strategy of SoFi. You can't decide to go all in on your app and provide products with very, very little margin to gain market share. You can't do that if you're a legacy bank, and so that's why new players come in. My favorite new player in the neobank space in the US is SoFi. SoFi and HIMS have a similar story in a way, in the sense that the market gives them no credit, but quarter after quarter, they keep making more money and surprising to the upside, and the market gives them no credit whatsoever. This is kind of the opposite of, say, a data warehousing stock, AI stock, or, say, for example, a chip stock, right? Chip stocks had some very disappointing results, not within the past 6 months, but the 6 months prior to that, and the market was giving them a lot of credit. And the same is true for AI. If you look at the run of Palantir, the Palantir's commercial business is still not doing too well. Palantir's results, you could question how they're good. I like them, but are they really as good as some had hoped? No, but the stock is more than double what it was just a few months ago. These companies are getting a lot of credit from the market. SoFi and HIMS and Nubank, to a lesser extent, are showing outstanding growth. Everything is doing amazing, and the market is giving them absolutely no credit. And one day, over the long term, the market is a weighing machine. One day there will be credit given to these companies. It's very obvious to me. So SoFi, growing very fast, attracting a lot of Gen Z, a lot of younger millennials. Their product is kind of to have a category killer in each category, right? They try in the credit card business, they try to have the best credit card. In the checking account interest rate, how much you earn on your checking account, they try to have the best interest rate. In the student loan refinance business, they try to have the lowest student loans. So they use the fact that they have no structure whatsoever to give back to the customer and disrupt existing legacy bank, because they end up having the number one product in each category, because this is a company that is obsessed with growth and obsessed with customer satisfaction, just like a modern company would do. And the same story is true for Nubank, and for Nubank in Latin America. Nubank is doing very, very well in Latin America. Nubank's growth is higher, in my view, because you don't have to convince someone to quit their legacy bank to go with Nubank. You don't have to convince them to quit banking with a legacy institution. SoFi has to do a little bit of convincing, because most of us are banking with a legacy bank, and so you have to make the switch, and it takes a little more convincing. And that's why if you look at, say, the customer acquisition cost of SoFi, it's quite higher than the CAC of Nubank. Nubank has one of the lowest out there, because you're competing against people who have no bank account, right? So you go from no bank account to the app, and you never know what a bank is, because you go straight to the app. That's new demand, fully new demand, fully new blue ocean. It's kind of, in a way, if you look at Nubank has a blue ocean for itself. SoFi is still competing somewhat in a red ocean and has to gain customers from a lot of US users. And I will finish with platforms. So you may remember I had 2 other platforms in there, but I had not covered them in months, and I'm running out of time. So I'm trying to do the best coverage I can. So sometimes I'm reducing my universe. The platforms here that I use is Airbnb. I think Airbnb is disrupting hotels, of course, but this is a story that is well known, and an adoption that's well on its way. But Airbnb, to me, is simply disrupting housing and how people that rent their spaces live. How do these people who rent their spaces live? Well, it's disrupting, for example, the mom and pop business, where the mom and pop business of renting a home, you would require a 12-month lease. Well, if you go for Airbnb, you don't have that issue of having to sign a long lease. You can be like, okay, I'm gonna stay on this Airbnb for a month, and then move to another Airbnb and move to a third Airbnb, etc. So you have a lot of Gen Z who say, oh, I'm just going to live on Airbnb. You can also do a lot of long-term rentals on Airbnb. It's disrupting hotels. It's a low-cost disruptor. If you're traveling something else than as a couple, if you're not two people traveling, Airbnbs most of the time are going to be cheaper. And Airbnb is also a cash machine. It's one of these businesses, just like StoneCo. It's one of these businesses that both value investors and growth investors can get behind because they kind of have the best of both worlds. It's a money making machine. Their net margin, although I never focus on net margin on this channel, but the net margin of a company like Airbnb is through the roof, and it makes sense, right? Because what is your customer acquisition cost for Airbnb? Well, it's the sellers of the network. And the sellers on the network just come and sell their space, right? They just come on their own on the network. So you have to pay very little to acquire these new hosts. Very little, much less than, say, a marketing campaign. So platforms are a very, very powerful business of the 21st century, just like SaaS and subscriptions. That's another powerful business. Love the business model. That was Airbnb. Airbnb is right in line with my spreadsheet as far as valuation goes. And this was it. This was every single stock in my coverage universe. Not investment advice at all, just entertainment. I hope you were entertained. Appreciate your likes. Appreciate your subscribes. Thank you so much for watching and have a wonderful, wonderful day. Thank you.